I've said it before, and I'll say it again, trading isn't about catching every tick or guessing what happens tomorrow. It's about understanding the rhythm of the market, the points where it holds firm, and the places where it breaks down. That's why today I want to speak to you about the hidden power of support and resistance. And it ties right into what we covered in the previous video on the rule that helps you catch big moves. Because without understanding where the market digs in and where it surrenders, you'll never have the nerve or the patience to hold for those big swings. Now, let me tell you something from experience. Prices don't move in a straight line. They surge, they pause, they retreat, they test. You've seen it on the tape. A stock climbs to a certain level, hesitates, pulls back, and then either pushes through or collapses. That hesitation, that line in the sand, that's what we're talking about when we say support and resistance. And here's the funny thing. Those levels are as much psychological as they are technical. They exist because traders believe they exist. Do you see the irony? The market is nothing more than a crowd of opinions, money, and fear, all painted in numbers on the tape. Let me ask you this, have you ever bought a stock, right, where you thought it was safe, only to watch it break through that so-called safety line and punish you? That's the danger of not respecting these levels. Support isn't a guarantee. Resistance isn't an iron ceiling. They're points of decision, places where the market shows its hand if you're patient enough to wait for the reveal. I remember plenty of times when I sat watching a stock hammer against the same number day after day. The amateurs said, "It won't go higher, it's too expensive," but the tape kept showing buying pressure. The bids held, the offers got eaten up. That ceiling that looked so firm to the crowd. To me, it looked like a door about to break off its hinges. And sure enough, once it went through, it shot up like a powder keg. Why? Because resistance isn't just a price. It's a trap for the shorts, and once that trap is sprung, they scramble to cover, fueling the very move they thought impossible. But don't think support and resistance are only about breakouts. No, the smarter game is to watch how price behaves around those levels. That's where the truth lies. Does the market respect the floor? Do buyers step in with conviction, or do they test it weakly, showing fear and hesitation? That's the clue. That's the signal. And if you're sharp, you'll recognize when the market is telling you it's about to reward patience or punish stubbornness. Let me pause here and ask you, do you see how these levels aren't magic lines but living battlegrounds between bulls and bears? Too many traders think drawing a line on a chart gives them an advantage. It doesn't. It's how you read the behavior at those lines that gives you the edge. The tape doesn't lie, but your interpretation can. There's a wealth principle buried in this idea. Wealth doesn't come from constant action. It comes from discipline, from waiting for the fat pitch, as some call it. If you chase every swing, you'll bleed yourself to death in commissions and small losses. But if you can wait for the market to come into your zone, the level where support or resistance is tested, you shift the odds in your favor. And isn't that what trading really is? Not certainty, but probability stacked your way. Think back for a moment. Remember when we talked about the rule that helps you catch big moves? The same patience required to ride a trend is required to let support or resistance prove itself. One without the other is half a strategy. Together, they form the whole, because it's no good to hold a stock for a big move if you don't know when that move is valid and when it's a false start. Now let's talk psychology, because support and resistance live as much in your head as they do on the chart. When a stock hits support, what happens? Traders who bought lower start telling themselves, if it breaks this, I'm out. That creates a pocket of fear, a cluster of stop-loss orders waiting to be triggered. On the other side, value hunters are saying, this is cheap, I'll buy here. That creates a pool of demand. So, the level becomes a zone of tension, a tug of war. Whichever side has more conviction wins, and the loser fuels the winner's victory. That's the hidden power. And resistance. That's the mirror image. Imagine a stock climbing back toward an old high. Traders who bought at the top months ago, and suffered through a long decline, finally see their price again. Relief floods them. They sell just to get out even. At the same time, momentum players are piling in, saying, if it breaks out, I want a piece. Again, tension builds. Do you see the recurring theme? Support and resistance are the crowd's memory etched into the chart. I'll tell you another thing. The best trades come not from guessing, but from watching the behavior when those memories are tested. Do you notice how the volume swells when a level is attacked? Do you notice how quickly or how slowly the price reacts? Those are your clues. The crowd tips its hand in the heat of the moment. All you have to do is sit still, observe, and act when the probabilities tilt far enough in your favor. Do you ever feel restless when the market is quiet, as though you should be doing something? That's where most traders fail. They act because they're bored, not because the market is giving them a signal. But the professional waits. He knows that every wasted trade eats into his mental capital, not just his financial account. And believe me, mental capital is harder to replenish than dollars. When you blow your discipline, you're no longer fit to read the tape. That's why support and resistance are gifts, natural checkpoints that tell you when it's worth risking your money and when it's not. Now, let's dive deeper. Support isn't always horizontal. Sometimes it's a rising line where the stock respects an uptrend. Each dip gets bought higher than the last. That tells you the buyers are growing stronger, the demand is persistent. The same applies in reverse for resistance on a downtrend. Each rally peaks lower than the one before. That's the market whispering, don't be fooled. The path of least resistance is still down. Do you catch that subtlety? It's not just where the line sits, but the slope of the line that matters. There's another thing I want you to understand. The market loves to fool the most people it can. Ever notice how a stock will break a support line by a few points, trigger the stops, scare the weak hands, and then bounce back violently? That's no accident. That's the professionals shaking out the amateurs. If you let yourself be part of that crowd, you'll always be on the wrong side of the move. But if you train your eye to recognize the fake breaks, the false moves, you'll see opportunity where others see disaster. And let me ask you, do you think those false breaks happen by chance? No, they happen because fear and greed are predictable. The crowd behaves the same way today as it did 100 years ago when I was trading in bucket shops. Human nature hasn't changed. Only the tickers and the screens have changed. Support and resistance were real then, and they're real now because the emotions behind them are eternal. But don't misunderstand me. I'm not saying you should buy every dip at support or sell every rally at resistance. That's the amateur's game. The professional waits for confirmation. He looks for the market to prove itself. A support level tested and held multiple times grows stronger until it finally breaks. And when it breaks, the fall is sharper because everyone believed it would hold. That's the trap. That's where fortunes are lost and made. Think about it. Isn't the richest lesson here about patience and timing? Wealth is built by those who can wait for the right setup and strike with size when the odds favor them. Not by those who nibble at every shadow. Support and resistance teach you that discipline. They force you to watch, to wait, to respect the market's decision instead of your own opinion. Do you see now how the hidden power of these levels isn't just in drawing lines on a chart, but in shaping the trader's mindset? It trains you to think in terms of probabilities, to respect the crowd without following it blindly, to balance conviction with flexibility. That's the edge. And without that edge, no strategy survives long. The power of support and resistance lies in patience, not prediction. That may sound simple, but in truth it's one of the hardest lessons a trader can ever learn. Most people come into this game with the wrong mindset. They want certainty. They want to be told exactly what will happen tomorrow, next week, or next month. They want to predict because prediction feels safe. It feels like control. But the market is a master at humbling anyone who tries to force certainty upon it. What you need instead is patience, the ability to wait for the market to show you what it's going to do at those critical levels, and the nerve to act only when the odds are clear enough. Think about it for a moment. What happens when a stock approaches a well-watched level of support or resistance? The crowd starts leaning in. Traders pile on with their opinions. Some say, it can't go any higher than this, while others insist, this breakout will run forever. At the same time, stop-loss orders build up on both sides. That price point becomes charged with emotion and money. Now, the impatient trader can't help himself. He guesses. He jumps in early, trying to front-run the move. Maybe he gets lucky once or twice, but more often than not, the market punishes him. Why? Because he's predicting instead of waiting. Patience, on the other hand, is about sitting still and observing the market's behavior at those levels. Does support hold with conviction, or do the bids vanish like smoke? Does resistance crumble under heavy buying, or does it repel the price and send it tumbling back? Those answers aren't found in guesses or hunches. They're revealed in the action itself, in the tape, in the character of the market. And to see them, you must wait. You must resist the urge to jump in before the evidence is clear. Let me ask you something. Have you ever noticed how the best moves often come right after the majority of traders have been shaken out? A stock breaks support, stops get triggered, the weak hands panic, and then suddenly it reverses and rockets higher. Or a stock pokes its head above resistance, tempts in the chasers, and then slams them with a reversal. If you were patient, if you waited to see the reaction after the break instead of predicting it, you'd be ready to spot the real move instead of being trapped in the false one. That's the power of patience. Prediction is intoxicating because it feeds the ego. You want to be right. You want to say, I called that breakout, or I knew it would bounce there. But trading isn't about being right, it's about making money. And making money consistently requires putting your capital to work only when the conditions are favorable. The market doesn't pay you for being early, it pays you for being correct at the right moment. That moment only shows itself with time, with observation, with patience. I've seen countless traders destroy themselves by overtrading at support and resistance. They buy too soon because they think the floor will hold. They sell too soon because they think the ceiling will cap the rally. And every time they're wrong, they dig a deeper hole. If they had simply waited to see the character of the move, they would have saved themselves from unnecessary losses. Isn't it ironic? Doing less often produces more in this business. The less you predict, the more you wait, the more your trades improve. Patience is also the foundation of wealth building through trading. Every large fortune made in the markets was made by sitting, not by jumping in and out every 5 minutes. When support proves itself and a trend emerges, the money comes to those who hold on with patience. When resistance finally gives way and a new leg of the move begins, the profits flow to those who resisted the temptation to bail too early. The crowd, driven by impatience, sells at the first sign of discomfort. The professional, armed with patience, waits for the market to clearly show a change before acting. That difference in mindset is the difference between giving your capital away and compounding it. Now, patience doesn't mean paralysis. It doesn't mean doing nothing forever. It means knowing when to do nothing and when to strike. It means you don't act because of boredom, but because the market gave you a reason. Have you ever caught yourself forcing a trade just because you hadn't taken one in a while? That's impatience disguised as activity. The professional understands that the waiting is part of the job. The real work is sitting in front of the tape, watching the crowd reveal itself at those key levels, and then moving only when the evidence demands it. There's also a deeper psychological benefit to patience. Every time you predict and lose, you chip away at your mental capital. You start second-guessing yourself. You lose trust in your ability to read the market. But when you're patient, when you let the market confirm your thesis before committing, you preserve that mental strength. You take fewer trades, but they're cleaner, clearer, and more confident. And that confidence compounds along with your capital. Support and resistance are perfect teachers of patience because they force you to wait for proof. A level may look obvious on a chart, but until you see how the market behaves there, you don't know if it will hold or break. If you're patient, you learn to spot the difference between a strong defense of support and a weak one, between a genuine breakout of resistance and a false one. Prediction blinds you to these details because you've already made up your mind. Patience keeps you open to whatever the market reveals. Let me ask you directly, do you want to be the trader who guesses or the one who observes? Do you want to gamble on your opinion or build wealth by letting the market prove itself to you? The hidden power of support and resistance is unlocked only by the latter choice. The lines themselves aren't magical. What makes them powerful is the discipline they demand from you. They're opportunities to practice patience in a world obsessed with prediction. And consider this: markets are designed to test your nerve. They move just enough to tempt you in, then whip back to shake you out. If you rely on prediction, you'll always fall for these traps. If you rely on patience, you'll sidestep them. You'll wait for the crowd to exhaust itself, for the false moves to play out, and then you'll take your shot when the path of least resistance is clear. That's when patience pays not because you knew what would happen, but because you waited to see what did happen. The irony is that the impatient trader thinks he's being active, but in reality, he's just feeding the market his money. The patient trader, on the other hand, appears inactive, sitting still while others scramble. But when the moment arrives, his action carries weight. He has the capital, the clarity, and the conviction to strike hard, and the results speak for themselves. So the lesson is clear: support and resistance aren't about predicting the future. They're about testing your ability to wait, to watch, to respect the market's verdict instead of forcing your own. That's where their hidden power lies. It isn't in the lines themselves, but in the patience they demand, and the discipline they build in the trader who respects them. Professional traders wait for confirmation. Amateurs act on first touch. That simple difference separates the few who build fortunes from the many who hand theirs away. An amateur looks at a chart, sees the price come down to support or rise up to resistance, and he jumps. He believes the market owes him a bounce or a reversal simply because the price touched a line he drew. He acts on contact. He doesn't wait to see whether the market agrees with his opinion. A professional, on the other hand, knows better. He knows that the market doesn't respect lines, it respects money and conviction. He waits to see which side has the stronger hand before putting his own money on the line. Think of how many times you've seen a stock poke its head through resistance only to collapse back below. That's the graveyard of amateurs. They buy the instant it touches or slightly breaches the line, thinking they've caught the breakout early. But because they didn't wait for confirmation, because they didn't watch how the stock behaved after breaking out, they end up holding the bag. The professional avoids this fate by demanding proof. He waits for the price not just to cross the line, but to hold above it, to attract volume, to show that buyers have truly taken control. That waiting makes all the difference. Do you see the psychology here? Acting on the first touch is driven by impatience and ego. The amateur wants to be first, wants to say he called it, wants the thrill of being right before everyone else. But the market doesn't pay for ego, it pays for discipline. The professional knows he doesn't need to be first. He needs to be on the right side when the odds are strongest, so he lets the market prove its intent. That's confirmation. That's the edge. Let me ask you something. When you've acted too quickly at support or resistance, how often did you get chopped up by false moves? Maybe the stock touched support and bounced for a few minutes, giving you hope, only to break down and keep falling. Or maybe it tapped resistance and pulled back just long enough to convince you the level would hold, then ripped higher without you. That whipsaw is the cost of acting without confirmation. Every premature trade is a tax paid to the market for your impatience. Professionals don't pay the tax because they know better than to confuse a touch with a true move. Confirmation comes in many forms. Sometimes it's the price holding above resistance for several sessions instead of just minutes. Sometimes it's volume swelling to show real participation. Sometimes it's the failure of a false move, where the market quickly reverses back through the level and reveals the trap. The point is, confirmation means waiting for behavior, not just price. The amateur looks at the number. The professional looks at the reaction, and that subtle difference changes everything. Now understand this clearly. Waiting for confirmation doesn't mean you'll never lose. Losses are part of the game. But by waiting, you filter out a mountain of bad trades that would have drained your account and your mind. The goal in trading isn't to win every time. It's to preserve your capital long enough to be present when the real move comes. Acting on first touch is death by 1,000 cuts. Waiting for confirmation is survival until opportunity. There's also a money management principle here. Amateurs who act on first touch take too many trades. Their accounts bleed from constant small losses. Professionals who wait for confirmation take fewer trades. Their accounts benefit from selectivity. And here's the irony, taking fewer trades usually leads to bigger profits, because you're only in the market when it matters most. Wouldn't you agree that it's better to hit one fat pitch than to swing at every ball thrown your way? Another layer to this is how confirmation reinforces discipline. Every time you force yourself to wait, you're building mental capital. You're proving to yourself that you can resist the crowd's urge to act impulsively. And when the confirmation finally comes, your entry has more weight because it's backed by evidence, not just hope. Amateurs burn out quickly because their confidence evaporates after a series of false starts. Professionals build confidence over time because their patience pays off in cleaner trades. Consider resistance as an example. When price touches resistance, amateurs often short immediately. They want to catch the top. But the professional asks, will sellers really defend this level, or will buyers overrun it? He waits. If the stock rejects resistance sharply, with heavy selling volume, that's confirmation. If it stalls, chops sideways, and then lifts higher, that's also information. It's telling him the sellers are weak. Either way, he isn't guessing. He's reading the tape, letting the market speak. Support works the same way. Amateurs buy the first dip into support, thinking it's a guaranteed floor. But floors break. A professional knows that. He waits to see if buyers step in with conviction. He looks for multiple tests, higher lows forming, or strong reversals. If support holds with energy, then he acts. If it breaks and collapses, he stays away or even goes short. Confirmation gave him clarity, while the amateur lost money clinging to a line. Do you notice the theme? It all comes back to patience. Acting on first touch is the opposite of patience. It's the illusion of control, the belief that drawing a line gives you an advantage. But those lines are only as strong as the market's behavior around them. Without confirmation, they're nothing but ink. The professional accepts that reality, and that acceptance is what keeps him in the game long enough to win. Here's something else worth thinking about. The market is designed to punish those who act on first touch. Why? Because the crowd always sees the same obvious levels. When price comes into support, stops are stacked underneath. When price presses against resistance, breakout buyers rush in. Smart money knows this. They use it. They trigger stops, shake out amateurs, and only then reveal the real move. Acting on first touch puts you in the crowd's trap. Waiting for confirmation keeps you aligned with the smart money. And don't underestimate the emotional relief that comes from trading with confirmation. Instead of sitting in constant doubt, will this bounce hold, or will it break? You enter with the reassurance that the market already answered the question. That reduces stress, and reduced stress means clearer thinking. Clear thinking is a professional's greatest weapon. So the real difference is not about drawing lines differently or having a secret indicator. It's about mindset. Amateurs think being early is the same as being smart. Professionals know being early is often the same as being wrong. Amateurs crave action, professionals crave clarity. Acting on first touch gives you action. Waiting for confirmation gives you clarity. And clarity is what pays. Support and resistance are not fixed lines, but psychological battlegrounds between buyers and sellers. That's the first truth most traders never really learn. They draw a neat horizontal line on a chart and convince themselves that the market must respect it like a wall, but the market doesn't obey ink on paper. What it obeys is money, fear, greed, and memory. These levels exist not because of geometry, but because thousands of traders, investors, and speculators all focus on them at once, turning them into zones of conflict. Imagine a stock that has climbed for weeks and finally hits a round number, say 50. It stalls. Traders hesitate. Why? Because 50 isn't just a number. It represents profit taking for those who bought lower, hesitation for those who think it's too high, and temptation for those who fear missing out. That stall becomes resistance. The next time the price climbs toward 50, everyone remembers what happened before. Sellers prepare to defend. Buyers hesitate again. Suddenly, it feels like 50 is a brick wall, but in reality, it's nothing more than a psychological battleground where opposing forces meet. Support works the same way. When a stock falls to a certain price and finds buyers, that price becomes etched in memory as a floor. Traders say, last time it bounced here, maybe it will again. Buyers camp there with orders. Sellers start doubting their conviction. The next approach to that level is loaded with emotion. But just as with resistance, it isn't the line itself that matters, it's the behavior of the crowd at that line. If buyers step up, support holds. If fear overwhelms them, the floor collapses. It's always a fight, never a certainty. Let me ask you something. How many times have you seen a price level broken only to watch the stock reverse back, as if mocking everyone who jumped in? That's the essence of this battleground idea. The amateurs believe the line is ironclad. The professionals know it's a zone of war where one side will test, the other will defend, and only when the outcome is clear can you act with confidence. The line doesn't decide, the crowd does. This is why treating support and resistance as exact points leads to so much frustration. The market doesn't move in perfect straight lines. It overshoots. It shakes out. It wicks above resistance and below support to test conviction. That's not random noise. That's the battleground in action, with one side probing for weakness and the other trying to hold ground. Those false breaks are nothing more than scouts in a war, testing defenses. If you understand that, you stop being fooled by every tick and start reading the story behind the moves. Now, here's where the psychology deepens. Every time a support level holds, confidence builds. More traders believe in it, more orders stack there. That makes the battleground stronger for a while. But paradoxically, the more a level is tested, the more fragile it becomes. Think of it like a fortress under siege. Each attack weakens the wall. Eventually, the defenders tire, supplies run low, and one final push breaks through. When that happens, the fall is sharp because the crowd that trusted the support suddenly realizes it was betrayed. Panic selling cascades. That's the hidden danger of treating support as unbreakable instead of as a contested zone. Resistance plays out in the same way. The more times a stock bangs against the ceiling, the more tempting it becomes to believe it will never break through. Yet each test absorbs supply from sellers. Each attack chews through more offers. Eventually, the wall gives way, and the breakout is violent because the sellers who relied on resistance are now trapped. Add in the short sellers covering their positions, and you have the fuel for a sharp rally. Again, it's the battleground principle at work. Confidence builds, then collapses, and the losing side's retreat fuels the winning side's victory. Do you notice how these levels aren't just technical but deeply human? Support and resistance are the footprints of crowd psychology, their fear and greed written into price. At support, buyers fear missing a bargain and sellers fear pressing their luck. At resistance, buyers fear overpaying and sellers fear losing their profits. Those fears and hopes collide at every test. That's why no indicator is needed to draw the lines. The crowd shows you where they are by how it reacts. Let me ask directly, do you really believe that a market falls exactly to the same price and reverses because of magic? Or is it more likely that human beings, remembering the past, cluster their decisions around those prices? That's the battleground. That's why these levels work. Not because they're precise, but because they concentrate the emotions and orders of the crowd into narrow zones. There's also a wealth-building principle tied to this idea. Most traders lose because they expect certainty. They believe support must hold or resistance must reject. When they're wrong, they get whipsawed, frustrated, and reckless. The professional, understanding the battleground, sees it differently. He waits. He watches the battle unfold. He doesn't need to predict. He only needs to recognize when one side has clearly gained the upper hand. That's when he acts. That patience, that ability to let the fight play out, is what preserves capital and positions him for the big moves when they come. Think about what happens when support flips to resistance or resistance flips to support. That's the battleground shifting sides. The stock falls through a floor. Later, when it rallies back to that level, the same traders who once saw it as support now treat it as a ceiling. Why? Because they were burned. They remember buying there and losing money. They're eager to sell now just to escape even. That memory transforms the battleground, turning defenders into attackers. The opposite happens when resistance breaks and later acts as support. The crowd's psychology flips, and the battleground shifts roles. Volume is another clue to the ferocity of the battle. When price nears support with heavy volume and holds, that's strong buying conviction. When it fails on heavy volume, that's a rout. At resistance, heavy volume on a breakout tells you the attackers are overwhelming the defense. Light volume, and it may be nothing but a fint. Professionals use volume as a way of gauging how strong each army is at the battleground. You know, I've been around markets long enough to see the same thing happen over and over again. It's funny, isn't it? Men call themselves smart. They say the market is different this time, but it never is. History repeats itself in the market because human nature never changes. Greed, fear, hope, ignorance, they were there yesterday. They're here today, and they'll still be here tomorrow. Have you ever seen a man who bought at the top suddenly turn calm when the price drops against him? No, he clutches his stock tighter, prays for a bounce, and rides it down. And when it finally recovers, he sells too soon because the sting of that pain is still fresh. Doesn't that sound familiar to you? Haven't you seen it on the charts? Haven't you felt it yourself? That's why I say, you don't trade stocks, you trade people. A chart is nothing but human emotion plotted in price and time. Those little bars and lines, they're footprints of the crowd. Every rally, every panic, every quiet spell is the same pattern repeating because the people behind it never change. And when you can read those footprints, when you can step back and see that a breakout today looks just like a breakout 10 years ago, you realize that history repeating isn't just an old saying, it's the only constant law in speculation. But here's the catch. Most folks look at a chart and think it's telling them the future. It's not. It's telling you the present, the truth of what people are doing right now. And the truth, when you study it long enough, points to what usually comes next, because the crowd doesn't change its habits. When a stock builds a base, then lifts off, the run looks just like it did in the bull markets of years past. And when a bubble bursts, it always leaves the same wreckage on the tape. So let me ask you, why would you fight against what the chart is telling you, if you know it's just human nature repeating? The real trouble is, the average trader doesn't believe history repeats. He thinks the situation is unique. He convinces himself that this time the stock will act differently, or this time the market can't fall because there's too much money on the sidelines. Haven't you heard those arguments? And yet, what happens? The same old story. The bull climbs, the crowd piles in, the weak hands get shaken out, and when the music stops, the same excuses are made for why they lost. Always the same? I used to sit in bucket shops as a boy and watch these men day after day. They'd buy because somebody whispered a tip. They'd sell because they got nervous. They'd blame bad luck when the market turned against them. And all I did was watch the tape, mark down prices, and look for the same old formations. I made my living because I believed history does repeat, while they kept believing it didn't. Do you see the difference? That's not brains, that's discipline. Anybody can learn that if they want to. The market's never wrong, but people are. Have you ever caught yourself arguing with a chart? You say, it's gone up too far, it can't go higher, but the tape keeps climbing. Or you say, it's already dropped too much, it has to rebound, and it keeps sinking lower. That's you arguing with history. That's you telling human nature it must change. But it won't. The law of supply and demand, the push and pull of fear and greed, it's the same now as it was in 1907 or 1929 or any other year you care to name. You want to build wealth. Then you learn to stop arguing and start listening. You trade with history, not against it. The funny part is, even when men see it, they still don't believe it. Take a look at your own record. How many times have you said to yourself, "I knew it would break out, I saw the pattern, but I didn't act"? That's you ignoring history. You recognized the play, but you didn't trust it. Why? Because you thought your feelings mattered more than the market's memory. The only way you ever build a fortune in this game is by aligning yourself with those repeating patterns and cutting off every trade that doesn't fit the law you've already seen 100 times before. Now don't misunderstand me. I'm not saying it's easy. If it were, everybody would be rich. The difficulty isn't in reading the tape, it's in controlling yourself. It's in killing that voice that says, "Maybe this time is different." That's the most expensive phrase on Wall Street. This time is different. It never is. Prices may move faster today. The volume may be bigger. The headlines may be louder, but the essence is the same. Think back to every great boom. Railroads, steel, oil, radios, dot-coms, electric cars. Crypto, it's always the same fever dressed in different clothes. Do you see the pattern? Doesn't that tell you that history is the only guide you really have? What makes a trader last isn't catching tips or gambling on hunches. It's learning the repeating cycle and respecting it. Breakouts work because demand overwhelms supply. Panics collapse because supply crushes demand. Between those two poles, the market writes the same story chapter after chapter. Your job is to recognize the chapter you're in and act accordingly. Tell me, why would you bet your money on a new story when the old one has been written the same way for 100 years? I've been ruined more than once in my career. You think I didn't know the rules back then? I knew them. But I didn't follow them. I thought I was smarter than the law of repetition, and the market punished me every time. It doesn't forgive arrogance, it doesn't bend to your will, and it doesn't care about your opinion. It only respects discipline. And discipline means standing aside when the pattern isn't clear and hitting hard when it is. Haven't you noticed how the biggest money comes not from constant action, but from waiting, from sitting tight when the market confirms what history has shown time and time again? Most traders don't fail because they can't read a chart. They fail because they can't read themselves. They get excited, they get scared, they get restless. They forget that the same emotional traps that caught men 50 years ago are still catching them today. That's the cruel joke of the market. You already know history repeats, but you keep behaving like it won't. Doesn't that sound a bit like insanity? And yet, every day the market opens, men walk right back into the same trap. That's why I say the hardest work in speculation is not in studying stocks, but in studying your own reactions. You learn to trust what the chart is whispering, not what your heart is shouting. You learn to sit out when the formation is vague, and you learn to strike without hesitation when the signal is clear. That's the way to survive. That's the way to prosper. The man who keeps his eyes on the tape and his emotions in check is the man who proves every day that history does repeat, and that he can profit by it. Now think about this for a second. What is wealth in trading? It's not one lucky score. It's not a quick killing. It's the steady compounding of right action repeated over and over. Just like the market repeats, your discipline must repeat. A breakout is only valuable if you treat every breakout the same way. A stop loss is only protection if you always obey it. One exception destroys the law. Do you see the parallel? The market's law is repetition, and your law must be repetition too. Isn't that the only way you build something that lasts? Wealth in the market is not built on luck, no matter what the crowd believes. It is not a lightning strike, a sudden miracle, or a single winning ticket. Wealth is built on repetition, on doing the right thing again and again until the small victories pile up into something greater than you imagined. The man who makes a killing on one bold gamble will almost always lose it just as quickly, because he mistakes chance for skill. Haven't you seen that before? A fellow catches one big move, he boasts, he struts, and before long he's wiped out because he thought he was smarter than the market. That's the nature of luck. It deceives you into thinking you can repeat it, when in truth it cannot be repeated at all. Now look at the disciplined trader. He doesn't boast of sudden fortune, because he knows wealth is not sudden. He builds brick by brick, trade by trade, following rules that don't change just because the market mood shifts. That's the man who understands that the market is a machine of repetition, and to profit from it, he must make his actions repeat just as consistently. Do you see how that works? The same law that governs the crowd governs you. The crowd repeats fear and greed, so the chart repeats its patterns. And you must repeat your discipline, so your account repeats its growth. Every fortune I ever made came not from one lucky strike, but from sitting tight on a sound position and obeying my own rules. The big money was not in the buying or the selling, but in the waiting. And waiting is nothing more than repeating patience each day, each week, until the cycle runs its course. Can you wait like that? Can you resist the urge to act just for the sake of acting? Most men cannot, and that's why most men never see true wealth. They take a profit too soon. They let a loss run too long. They violate their own rules. They break the chain of repetition, and in that single break, they undo months of sound work. Think of compounding. Every schoolboy knows the principle, yet few traders live it. Compounding is nothing more than repetition turned into mathematics. You grow a little, you protect it. You grow again, and you protect again. The power comes not from the size of one gain, but from the steady march of many gains added together. Wealth is a reflection of discipline, repeated so often that it becomes second nature. Haven't you noticed how the traders who last in this business don't seem to get excited? Their wins don't thrill them, their losses don't crush them. Why? Because they see each trade as one step in a repeating process, not as a final verdict on their fortune. The crowd hates repetition. They want excitement. They crave a new story, a fresh tip, a sudden windfall. That craving is why they lose. They abandon sound principles for the thrill of novelty. But the market, in its cold truth, doesn't pay the man who seeks excitement. It pays the man who respects the dull discipline of doing the right thing again and again. Do you understand what I mean when I say dull discipline? It's boring to stick to your stops every time. It's boring to wait for the same setup you've traded 100 times before. But that boredom is wealth. That boredom is freedom. And the thrill seeker who jumps for novelty will always pay for the disciplined man's patience. In my early days, I too was seduced by the idea of the quick killing. I thought if I could only catch the big swing, I'd be set for life. And I did catch them a few times. But I also gave it back, because I hadn't yet learned the deeper law. The law is not to catch one big move, but to catch many moves correctly, to repeat correct action so often that the result is inevitable. That is what builds true wealth. It is slow at first, like watching a sapling grow. But over the years, that repetition becomes a tree with roots deep enough to weather any storm. Every loss I ever took taught me the same lesson: stick to the rules without exception. The rules exist to be repeated, not to be bent. You might think one exception doesn't matter, but it always does. That one time you move your stop just a little lower because you hope the market will turn. That one time you take profits too soon because you want to lock it in that is the one time that erases months of disciplined gains. Haven't you felt that sting? Haven't you seen how hard it is to rebuild after one careless break in discipline? That is the cost of abandoning repetition. Wealth, like the market itself, is a creature of habit. The market repeats because men repeat, and your account grows because you repeat discipline. That is the mirror. If you are careless one day, you will pay for it. If you are consistent every day, the reward will come. The trouble is that human nature fights against consistency. We get bored, we get greedy, we get afraid. And so the trader's real battle is not with the market, but with himself. If he can win against his own impulses, then the repetition that builds wealth becomes as natural as breathing. Let me ask you, how many times have you taken a profit just because you wanted the relief of being right? How many times have you cut a winner short and then watched it run another 50 points without you? That's not discipline, that's impatience. And impatience is the enemy of repetition, Because repetition demands that you treat every winning position the same way, letting it play out until the market itself says the run is over. Cutting it short breaks the pattern, and once you break the pattern, you break the wealth it was building. The great fortunes are never made by men who chase every move. They are made by men who identify the repeating setup, act only when it appears, and act the same way every time. If you change your method because you feel different today, you have already lost. The market doesn't care how you feel. The chart doesn't adjust itself to your mood. It repeats itself, cold and steady, because the crowd repeats its behavior. And you must answer with your own repetition, steady and cold, unmoved by feeling. Isn't that the real test of a trader? Most men can follow rules for a week, maybe a month. They get tired, they get restless, they crave something new. But wealth only comes to the man who repeats discipline for years, for decades. He may not look clever. He may not sound exciting. But his account tells the truth. You see, in speculation, it's not the brilliant who survive, it's the consistent. The one who can repeat without fail. And here is the final irony. When you master repetition, your wealth begins to look like luck to everyone else. They say he's always in the right place at the right time. He's lucky. They don't see the years of repeating the same study, the same patience, the same rules. They don't see the discipline behind the fortune. But you will know, if you live it. You will know that wealth was not built in one moment of brilliance, but in countless moments of repetition. Human nature drives the market, and human nature never changes. That is the first and last truth a trader must learn if he ever wants to last in this business. You can change the tickers on the board, you can invent new industries, you can fill the newspapers with new slogans, but underneath it all, the same two forces govern the crowd: fear and greed. Haven't you seen it yourself? A man buys a stock because he hopes it will rise, and when it does, he hopes for more. Another man sells because he fears it will drop, and when it does, he fears it will drop further. Hope and fear, greed and panic, they weave the same story over and over again. The tools change, the technology changes, but men don't, and because men don't change, the market doesn't change. I learned this lesson the hard way, sitting in bucket shops as a boy, marking down prices and watching how men acted around them. I saw fellows who had been beaten yesterday come back today with the same foolish hope. I saw them whispering tips, chasing the same mirages, and I saw them lose again. Didn't it ever strike you as odd that men could be whipped again and again by the same mistake and still come back for more? That's because human nature doesn't evolve in the short space of a lifetime. It repeats itself endlessly, and the market is the perfect stage where those repetitions play out in public. Think of a bull market. It always starts quietly. A few sharp eyes notice value, they accumulate in silence. Then prices creep higher, others take notice, and slowly greed begins to spread. At first, it's cautious greed. Then it's enthusiastic. Then it turns to frenzy, when even the shoeshine boy is giving tips. Haven't you read about it in every era? Railroads in the 19th century, automobiles in the early 20th, dot-coms at the turn of the millennium, cryptocurrencies more recently. Always the same pattern. Always the same explosion of greed, followed by the same collapse when fear takes its turn on the stage. The details differ, but the psychology never does. A trader who forgets this truth will always be caught off guard. He'll say, this time is different, but it never is. It may look different on the surface, but beneath the surface, it's the same human nature. A new technology doesn't change how men feel about money. A new government doesn't change the pulse of fear and greed. Haven't you noticed how every panic looks like every other panic when you strip away the headlines? Crowds rushing for the exits, selling at any price, while a handful of disciplined men quietly accumulate, knowing that fear always overreaches just as greed does. The market is nothing more than human nature expressed in numbers. That's why charts work. That's why tape reading works. You're not looking at magic, you're looking at people's emotions recorded day by day. When you see a breakout, what are you really seeing? You're seeing greed outpacing fear. When you see a breakdown, what are you seeing? You're seeing fear crushing greed. Every tick is a vote of human emotion. And when you've watched enough ticks, you realize they've been voting the same way for 100 years. Most men fight this idea because they want to believe they're unique. They tell themselves they'll outsmart the market by being cleverer, faster, more informed. But cleverness has never beaten the law of human nature. Clever men get ruined just as surely as fools, because cleverness makes them think the law doesn't apply to them. Haven't you noticed how the brilliant economist loses money while the plodding old trader keeps making it? That's not because the trader is smarter, it's because he respects human nature and doesn't argue with it. Let me ask you something. When was the last time you held a losing stock and said to yourself, "It'll come back"? Isn't that just hope speaking? And when was the last time you sold a winner too soon because you were afraid it would vanish? Isn't that just fear speaking? These are the same impulses that ruled the markets a century ago, the same impulses that ruined men in 1907, 1929, 2000, and every year in between. Nothing has changed. Human nature drives it all. This is why I say the market is never wrong, but people are. The market only reflects what people are doing, what they're feeling. If the crowd is greedy, prices rise. If the crowd is scared, prices fall. Simple as that. It doesn't matter what you think should happen. It doesn't matter what your opinion is. The only thing that matters is what human nature is producing on the tape. And if you can train yourself to read it without bias, you can ride it instead of being crushed by it. But here's the rub: most men cannot train themselves that way. They carry their human nature into every trade. They see a chart not as a record of human behavior, but as a stage for their own hopes and fears. They think it must go up because I bought it, or it must stop falling because I can't afford more losses. The market doesn't know you exist, and it doesn't care. All it knows is the crowd, and the crowd is driven by the same emotions that have ruled men since the beginning of trade. Don't you think it's foolish to bet against something so eternal? What separates the successful trader from the ruined one is not intelligence, but control. Control over himself. Control over those very impulses that drive the crowd. If you can stand apart, if you can see the crowd rushing into a stock and remind yourself that greed always overreaches, then you have a chance. If you can see a panic unfolding and remind yourself that fear always overshoots, then you have a chance. That is what makes a trader using the knowledge of human nature as a weapon instead of being its victim. Remember, the stock market is only a mirror. It shows you the truth about men's emotions magnified by money. When the mirror shows greed, it looks like a bull market. When it shows fear, it looks like a bear market. But the mirror itself never changes. Haven't you noticed that when you study old charts, the patterns look exactly like today's? That's because the men behind them are driven by the same unchanging nature. Technology may speed up the moves, communication may spread the frenzy faster, but the shape is always the same. Wealth comes from respecting this truth. When you build a method based on human nature, it doesn't expire. It doesn't need to be reinvented every decade. It lasts because men don't change. They are as impatient, as hopeful, as fearful, as greedy today as they were when railroads first hit the tape. That's why my principles worked then, and they work now. Not because I was a genius, but because I built them on the foundation of human nature, and that foundation never moves. Most men lose because they think they're playing against the market. They're not. They're playing against themselves, against their own emotions. The market is just the field where the game takes place. If you master yourself, you master the market. If you don't, you're doomed, no matter how much you study. Haven't you seen traders who know every statistic, every report, every piece of news, and still lose? And haven't you seen others who know little more than how to read a chart, but keep winning? The difference isn't information, it's mastery of human nature. So when I say human nature drives the market, I mean it in two ways. First, it drives the crowd, and that crowd creates the repeating patterns we all see on the tape. Second, it drives you, the trader, and unless you learn to control your own nature, you'll be swept away by the crowd's tide. The market doesn't beat you, you beat yourself. by letting fear and greed dictate your moves instead of discipline. And every ruined trader is proof of this law. Every boom and bust follows the same emotional cycle, and if you've studied the tape long enough, you'll see it clearer than daylight. The story starts quietly, always the same way. A new opportunity, a fresh idea, some development that captures the imagination of a few sharp minds. At first, the crowd ignores it. Prices sit still or drift in small ranges. Only the observant are buying, accumulating without noise. Have you ever noticed how the best moves begin when nobody else cares? That's the start of the cycle. Then comes the recognition phase. Word begins to spread. A few stories make their way into the papers. Friends whisper to friends about a promising stock, and the average investor takes a small nibble. Prices rise, and suddenly everyone feels clever for noticing it. Greed is awake, but still shy. People think they are cautious, but they're not. They're already slipping into the cycle. Haven't you seen this moment on the charts? The slow lift, the growing volume, the steady climb. It's the point when confidence begins to replace doubt. Soon after, confidence grows into excitement. Prices rise faster, the headlines get louder, and the public begins to believe the story is bulletproof. It doesn't matter if it's railroads in the 1800s, steel in the early 1900s, radio in the 1920s, dot-coms in the 1990s, or cryptocurrencies in recent years. The story changes, but the emotions never do. The crowd becomes convinced that this is a new era, that the old rules don't apply. Haven't you heard it before? This time is different. Those 4 words have marked every single bubble in history. When the mania sets in, the charts show it too. Prices don't just climb, they leap. Breakouts explode higher, pullbacks are shallow, and even the weakest hands make money. Everyone is a genius in a bull market, because the tide itself is lifting all boats. But what the novice calls genius, the experienced trader calls the dangerous middle of the cycle. Because when the crowd starts to believe prices can't go down, that's exactly when the top is being built. Have you noticed how the tape starts to get wild in those moments? Big gaps, big swings, faster moves, it's the fever of greed. At the peak, confidence becomes arrogance. The last buyers rush in because they fear missing out. The shushin boy, the cab driver, the clerk at the store, they all have tips. They all want in. That's the exact moment when the professionals, the disciplined men, are distributing their stock to the crowd. They are selling into strength, unloading their positions piece by piece, while the latecomers eagerly take the bait. The public thinks they're getting rich, but they're really buying the bags that the professionals no longer want. Doesn't that sound familiar to you? Then comes the turning point. It can be a headline, a rumor, a small shift in supply and demand. Prices hesitate, then dip. At first, the crowd ignores it. They say, it's just a healthy pullback. They buy more, thinking it's a bargain. But the smart trader watches the tape and sees the difference. He sees that rallies are weaker, that sellers are pressing harder, that volume is heavier on down days. The cycle is shifting. Haven't you noticed how the first cracks in a bubble are invisible to the crowd, but obvious to the disciplined eye? When the decline becomes undeniable, fear replaces greed. Prices fall, and instead of buying dips with excitement, the public begins to hold on with hope. It will bounce back, they say. It always has. Hope is the cousin of greed, and it blinds them just the same. They refuse to sell because selling means admitting they were wrong, and so they hold, even as losses grow. That's why bear markets don't start with panic, they start with denial. Haven't you seen how a stock can drift lower for months, while the crowd insists it's only temporary? Eventually denial turns into anxiety. Losses pile up, portfolios shrink, and the mood shifts. What was once a sure bet now looks uncertain. The headlines turn negative. Analysts who were once bullish change their tune. And as anxiety grows, selling pressure increases. Weak hands can't bear the pain any longer, and they begin to unload at any price. The decline accelerates. The same crowd that bought too late at the top now sells too late at the bottom. It always happens this way, because human nature doesn't change. Finally, fear reaches its climax in panic. This is the mirror image of the mania phase. Just as greed once pushed prices far above their real value, fear now drives them far below it. The tape shows wild swings again, but this time downward. Stocks are dumped at any price, fortunes are wiped out, and the newspapers shout about disaster. The public can't take it anymore, so they sell everything, swearing never to touch the market again. And while they're panicking, who's quietly stepping back in? The professionals, the disciplined traders, accumulating at the very prices the crowd is abandoning. Doesn't that complete the cycle in your mind? After panic comes despair, and with despair comes silence. The market stops making headlines. Nobody wants to talk about stocks anymore. The public wants nothing to do with speculation, because their wounds are too fresh. Prices stop falling, bases form, and slowly, accumulation begins again. The cycle resets, just as it always has. The faces are different, the tickers are different, but the rhythm is the same. Boom to bust, greed to fear, hope to despair, then back to hope again. That is the unchanging heartbeat of speculation. You can open the chart of any great bubble or crash and trace this cycle with your finger. The South Sea bubble in the 1700s, tulips in Holland, railroads, steel, oil, radio, dot-coms, housing, crypto, it doesn't matter which. Every chart is the same. Every emotional cycle follows the same path. And every time the crowd insists that this time is unique, that history has changed, that the old patterns no longer apply. And every time, they are wrong. The trader's job is not to predict the news or invent new theories. His job is to recognize where in the cycle the market stands. Is greed still building, or is fear creeping in? Are prices climbing because of real demand, or because of mania? Is the crowd hopeful, anxious, panicked? Once you can see the cycle for what it is, the tape becomes less mysterious. It's not about magic, it's about human nature, repeating itself as it always has. If you look at it honestly, the cycle is nothing more than a mirror of the emotions you've felt yourself. Haven't you ever felt the rush of buying into a hot stock, convinced it would never come down? Haven't you ever held too long, hoping against hope that your loss would recover? Haven't you ever sworn off trading after a painful defeat, only to come back again later when conditions looked better? That's the same cycle in miniature, playing out inside you just as it plays out in the crowd. The only difference is that the tape records the crowd's emotions, while your account records yours.